Is emotional reason the primary driver of financial markets? For those who incline to the emotional view, there may be support from examining financial bubbles, seasonality, overshooting, and even the tendency of markets to sell off following sporting defeats. To those familiar with financial firms, this last trait may be unsurprising. Traders are predominantly male, and chat around trading floors is often and tediously sports-obsessed. In a more rational world, markets are orderly and alpha is absent because information is rapidly and efficiently processed. This becomes a particular problem in periods of low volatility, when beta is also in short supply and traders start chasing other Greek letters. Persistence can be claimed by both sides. Momentum in markets tends to be stronger where investor profiles overlap. This implies shared goals and similar processing of information. However, it fits less well with a rational market where prices reach equilibrium quickly. The mechanization of markets also presents mixed evidence. Algorithms are founded in logic, so presumably at some level they are rational and help the markets to achieve faster, fair price discovery. The caveat is that in pursuit of speed or low latency, the logic is simplified and flawed, or at least limited in its applicability. As a pragmatic investor, does it really matter? Trying to disentangle emotion from reason in the context of markets seems to call for an arbitrary and somewhat artificial distinction. The conclusion will depend on the individual doing the analysis. If the market moves against you, it may feel wrong or irrational, but designating it as such will not recoup your losses. Following heavy losses on speculative trades, Keynes is supposed to have concluded that the market can remain irrational longer than you can remain solvent. If there was a single right price for an asset, there would be little incentive to trade over and above commercial transactions, for example, a farmer selling his wheat to a grain processor or miller. Richard Thaler argues that while there is no free lunch, it is still possible to beat the market, albeit with difficulty. One explanation for this is the variety of motivations, timeframes, valuation approaches, and opinions represented in a market that all feed into healthy price discovery. When market trading is dominated by one group of participants, whether algorithmic traders or index trackers or central bankers or government institutions, the outcomes are not noticeably benign. It's not clear that Daniel Kahneman's division of thinking into System 1 or System 2 is ultimately helpful here either. Kahneman, in Thinking Fast and Slow, separated types of thinking into that which is fast, instinctive, and emotional, or System 1, and that which is slower, deliberative, and logical, System 2. In markets, those who trade on instinct, the archetypal fast thinkers, may be seasoned traders doing no more than processing information internally and efficiently, the equivalent of doing mental arithmetic, rather than missing out logical steps. Pattern recognition plays a large part in markets. The extent is illustrated by the drop-off in trading volumes when participants are faced with something unfamiliar. Describing market conditions as unprecedented could be taken as a warning sign. For example, we've apparently been experiencing a period of unprecedented low volatility across multiple asset classes. Or it could be that the commentators need to widen their context. It is true that volatility in various equity markets, as well as bonds and currencies, is low, for instance, when compared with 10-year average values. However, if one looks back, equity volatility was lower in the early to mid-1990s, and bond volatility in the run-up to the global financial crisis in 2007, so hardly unprecedented. If the pattern being presented is unfamiliar, it may prompt investors to retreat to the sidelines. This response is also exhibited by the computer algorithms in high-frequency trading. This instinctive emotional fight or flight reaction in others also suggests that the unprecedented tag may signal an opportunity. In the interest of reconciliation, it could be that the aggregation of many individual emotional trades looks like a market driven by reason, because the individual biases are cancelled out and subsumed in feedback loops. This is more likely than the idea of the market as a hive mentality formed of individual, entirely rational trades. As for whether it matters, a common behavioral bias is the preference for narrative or a story to explain whether to buy or sell an asset, rather than hard data. It's the rationalization of market developments that underpins confidence.